How's it going, guys? Thanks for checking out my mortgage update. It's been a little bit since our last video, so thanks for bearing with me. And a huge shout out to the realtor referral partners that have been making it a busy couple of months. So, with that out of the way, let's hop into today's topic. We're going to be diving into where rates are at today, where they're going in the future, how the economy's been affecting rates, and how tariffs have been affecting rates so far this year. So, without further ado, let's get right into it. First things first, where are rates at today? Well, we are seeing that 3-year fixed rate sitting at around 4.3%. B rates have been sitting steady as well, around that mid 5% range. And the Bank of Canada, as you guys know, left the prime rate sitting at 4.95 last week. Now, we are still suggesting that clients lock in to a 3-year fix rather than the 5. The reasoning for that will become more clear throughout the video, but in the long term, rates are still expected to decrease. Why would you want to lock in at a higher rate for 5 years when you can secure the same rate for 3 and then refinance again when rates are low? But over the last couple of months, rates have been remaining steady, not moving up or down significantly. And it really does seem like lenders are still kind of in a wait and see approach with regards to tariffs and how the Bank of Canada really just reacts to its effects. Speaking of tariffs, it's widely expected that they'll have an inflationary effect on the Canadian economy. Higher duties on goods will mean that the higher prices will be passed on to the consumers. That said, the inflationary effects of tariffs have not been as significant as many expected at the start of the year. I think people just had a shock of, with inflation over the last couple of years, so they thought it was going to be, the end of the world. But anyways, the latest CPI report in June is the first set of data that shows us what effects and those tariffs will have on inflation. And though these effects haven't been immediate or as volatile or as significant, if inflation does continue to persist, don't expect any rate cuts from the Bank of Canada in September or throughout the rest of the year. As you guys can see, it is ticking up a little bit further in the month of June. The same is going to be expected for July, but you can see that CPI excluding energy is actually a lot higher than what that headline CPI is. It's sitting at around 2.5 for excluding all those volatile indicators. Here's the Bank of Canada Governor Tiff summing it up for us right here.
If I try to boil it all down for you, there are reasons to think that the recent increase in underlying inflation will gradually unwind. The Canadian dollar has appreciated, and that reduces import costs. Growth in unit labor costs have moderated, and the economy is in excess supply. But at the same time, tariffs are imposing new costs, which will be gradually passed through to consumers. In the current tariff scenario, the upside and downside pressures roughly balance out, so inflation remains close to 2%.
So you guys heard what Tiff said there. Inflationary effects and deflationary effects largely balance out. So if what Governor Tiff says is true, I expect that tariffs will run their course by the end of the third quarter 2025. This will open the doors for lower rates at the end of 2025. Businesses are smart, and consumers at the end of the day, they're sick of inflation from the last couple of years of high inflation. Rates will likely remain at their current levels until tariffs have run their course, and that'll allow the Bank of Canada to get back into their rate cutting scenario. But it's interesting because tariffs didn't just have an effect on the price of goods. They also affected how people buy homes. The chart that I've included here shows 3 values. It shows new construction in blue, renovations in teal, and ownership transfer costs in red. Let's highlight ownership transfer costs. Essentially what these are the costs associated with buying and selling a house. All else equal, the more costs means a higher number of transactions in a given quarter. The lower costs mean less transactions in a given quarter. And as you can see, in the first quarter of 2025, transaction costs were way down. Which means that homeowners were reluctant to buy. Why? Most likely because of tariffs and the effects that they might have had on their home buying purchase. Well, now I believe that the initial scare of tariffs are in the back seat and inflation is remaining stable, which means the housing sector is poised for a bounce back. To end off the video, we'll take a look at a very interesting piece of data that I love, and that's going to be GDP per capita. Over the last couple of years, it has been on a downward trend, but something really interesting happened in the first quarter of 2025. It's up. Maybe it's not by a significant margin, but it's still up. And the reasoning behind that could be that, companies bought before the tariffs went into effect. It could also be that, Canadian homeowners put off their purchases, effectively saving more money. It could be a combination of a lot of factors, but at the end of the day, GDP per capita is now on the ups and the first time it has been in a long time. I believe that this could be the start of a better trend in the Canadian economy. Based off all of the data I presented today, I believe that the second half of 2025 is looking to be the most stable environment for rates we've seen in quite a long time. So if you have clients that are looking for advice, please don't hesitate to reach out to me as, I'd be happy to help service their mortgage needs. And thanks for tuning in, guys. That's all I've got for you today. I hope you enjoyed. Thank you so much. Cheers. Bye.